Question 1. Governance review demonstrates that client requested a significant alteration to their commercial property insurance policy, specifically to increase the sum insured for a newly acquired annex. The broker verbally confirmed the increase with the underwriter and informed the client that the change was effective immediately. However, the insurer's internal process for issuing a formal policy endorsement for this change was delayed due to administrative backlog. Which of the following actions best upholds regulatory requirements and professional standards for documentation in this scenario? Option A. Issue a brief email to the client confirming the increased sum insured, referencing the broker's conversation, but defer the formal endorsement until the backlog is cleared. Option B. Issue a formal policy endorsement detailing the increased sum insured and the effective date, and send it to the client immediately, regardless of the administrative backlog. Option C. Inform the client that the change is noted, but will only be formally documented and issued as an endorsement at the next policy renewal to streamline administrative processes. Option D. Rely on the broker's confirmation and the client's verbal agreement, and update the policy records internally without issuing a formal endorsement until the next renewal. The correct answer is B. Issue a formal policy endorsement detailing the increased sum insured and the effective date, and send it to the client immediately, regardless of the administrative backlog. Explanation: this scenario presents a professional challenge due to the critical importance of accurate and complete documentation in the insurance industry, particularly concerning policy endorsements. The challenge lies in balancing the need for timely service to the client with the regulatory imperative to ensure all policy changes are properly recorded and communicated. Failure to do so can lead to disputes, regulatory sanctions, and reputational damage. Careful judgment is required to identify the correct documentation process that upholds both client expectations and regulatory compliance. The correct approach involves issuing a formal, written endorsement that clearly details the change, its effective date, and any impact on premium or coverage. This aligns with the regulatory framework that mandates clear and accurate record-keeping for all policy modifications. Such documentation serves as the definitive record of the agreement between the insurer and the insured, protecting both parties. Ethically, it ensures transparency and fairness by providing the client with a clear understanding of their updated policy terms. An incorrect approach would be to rely solely on verbal confirmation or an informal email from the broker without issuing a formal endorsement. This fails to meet the regulatory requirement for documented policy changes. It creates ambiguity about the exact terms of the endorsement, leaving the client vulnerable to misunderstandings and potentially invalidating coverage. Ethically, it is a failure of transparency and due diligence, as it does not provide the insured with the official confirmation of their policy alteration. Another incorrect approach would be to delay issuing the endorsement until the next renewal period. This is a significant regulatory failure, as policy endorsements are intended to reflect changes in coverage or terms that are effective immediately or from a specified date. Postponing documentation means the policy is not accurately reflecting the current risk and coverage for a period, which is a breach of regulatory requirements for up-to-date policy records. It also leaves the insured without official confirmation of their altered coverage. A further incorrect approach would be to issue an endorsement that is vague or omits key details such as the effective date or the precise nature of the change. This also constitutes a regulatory failure, as the documentation must be clear and unambiguous. Incomplete documentation can lead to disputes over coverage and liability, and it does not fulfill the insurer's obligation to provide accurate policy information. Ethically, it is a disservice to the client, who relies on clear documentation to understand their insurance protection. A professional decision-making process for similar situations should involve a clear understanding of the regulatory requirements for policy documentation. When a client requests a change, the immediate step should be to determine the appropriate documentation method. This involves consulting internal procedures and relevant regulations. The priority is always to ensure that any change is formally recorded and communicated to the client in a clear, accurate, and timely manner, thereby safeguarding both the client's interests and the insurer's compliance. Question 2. Comparative studies suggest that while insurers aim for efficient claims processing, policyholders expect fairness and transparency. A property insurance claim is submitted for fire damage. The claims handler notes some inconsistencies in the policyholder's initial statement and suspects the fire may have been deliberately set to claim insurance. The policyholder is distressed and eager for a quick resolution. What is the most appropriate course of action for the claims handler? Option A. Immediately deny the claim based on the initial suspicion of fraud, informing the policyholder that the claim is rejected due to potential misrepresentation. Option B. Offer a significantly reduced settlement amount to the policyholder, explaining it as a gesture of goodwill to expedite the process, despite the ongoing suspicion. Option C. Advise the policyholder that the claim will be processed only after they provide additional documentation that is not explicitly required by the policy or standard investigation procedures. Option D. Conduct a thorough and objective investigation into the cause and extent of the fire damage, gathering all relevant evidence, and assessing it against the policy terms and regulatory guidelines before making a decision. Correct answer is D. Conduct a thorough and objective investigation into the cause and extent of the fire damage, gathering all relevant evidence, and assessing it against the policy terms and regulatory guidelines before making a decision. Explanation. This scenario presents a professional challenge due to the inherent conflict between an insurer's desire to manage claims efficiently and the policyholder's right to a fair and transparent claims process. The claims handler must navigate the delicate balance of investigating a potentially fraudulent claim while upholding ethical obligations and adhering to regulatory requirements. The pressure to reduce payouts can tempt a handler to overlook nuances or apply policies too rigidly, potentially leading to unfair outcomes. The correct approach involves a thorough, objective, and documented investigation of the claim. This means gathering all relevant evidence, including the policyholder's statement, independent reports, and any other supporting documentation. The handler must then assess this evidence against the terms and conditions of the property insurance policy and relevant regulatory guidelines. This approach is ethically sound and legally compliant because it prioritizes fairness, due diligence, and adherence to contractual obligations. Specifically, under the Program in General Insurance (PGI) framework, which aligns with general insurance principles and likely reflects UK regulatory expectations for conduct, insurers have a duty to act with integrity and to treat customers fairly. This includes investigating claims diligently and making decisions based on evidence and policy terms, not on assumptions or pressure to minimize payouts. An incorrect approach would be to immediately deny the claim based on suspicion alone, without conducting a comprehensive investigation. This fails to uphold the duty of care owed to the policyholder and breaches the principle of treating customers fairly. It also risks violating regulatory requirements that mandate a proper claims handling process. Another incorrect approach would be to offer a significantly reduced settlement amount without clear justification based on policy terms or evidence of underinsurance. This could be construed as an attempt to exploit the policyholder's potential lack of understanding or to coerce them into accepting a less favorable outcome, which is unethical and contrary to fair claims handling practices. Finally, delaying the investigation unnecessarily or failing to communicate clearly with the policyholder about the process and reasons for any decision would also constitute a failure in professional conduct and regulatory compliance. Professionals should approach such situations by first understanding the policyholder's rights and the insurer's obligation. A systematic investigation process, clear documentation of all steps and findings, and objective assessment of evidence against policy terms are crucial. If there is genuine doubt about the validity or extent of the claim, further expert advice should be sought, and all findings communicated transparently to the policyholder. The ultimate decision must be justifiable, evidence-based, and compliant with all applicable regulations and ethical standards. Question 3. The monitoring system demonstrates a pattern of claims involving damage to a third party's property arising from an insured's business operations, where the policy's products liability section appears to be the most relevant, but the damage occurred during the installation phase of the insured's product, not after its sale. Which of the following approaches best aligns with the regulatory framework and ethical obligations for handling such a claim under the Program in General Insurance (PGI)? Option A. Investigate whether the damage falls under the operations liability section of the policy, considering the installation phase as part of the insured's business operations, and assess coverage based on the specific wording and exclusions within that section, while also reviewing PGI guidelines on policy interpretation and claims handling. Option B. Prove the claim under products liability by interpreting the installation as an inherent part of the product's delivery and use, despite the policy's typical distinction between pre-sale and post-sale events, to ensure customer satisfaction. Option C. Refer the claim to the insured for them to seek coverage from their own business insurance policy without conducting an internal assessment of the policy's applicability. Option D. Immediately deny the claim, stating that product's liability coverage is not applicable as the damage occurred during installation and not post-sale, without further investigation into other potential coverage sections. The correct answer is A. Investigate whether the damage falls under the operations liability section of the policy, considering the installation phase as part of the insured's business operations, and assess coverage based on the specific wording and exclusions within that section, while also reviewing PGI guidelines on policy interpretation and claims handling. Explanation: this scenario is professionally challenging because it requires an insurance professional to navigate the complexities of policy interpretation and regulatory compliance when faced with a claim that potentially falls outside standard coverage. The core challenge lies in balancing the insurer's obligation to uphold policy terms with the need to ensure fair treatment of the policyholder, all within the strict confines of the program in general insurance, PGI, regulatory framework. Careful judgment is required to avoid both underpaying legitimate claims and overpaying claims that are not covered, while maintaining regulatory adherence. The correct approach involves a thorough review of the policy wording, specifically the definitions and exclusions related to bodily injury and property damage, and cross-referencing this with the relevant PGI regulatory guidelines on claims handling and policy interpretation. This approach is correct because it prioritizes adherence to the contractual agreement, the policy, and the governing regulations. The PGI framework, like most insurance regulations, emphasizes clarity, fairness, and the principle of indemnity. By meticulously examining the policy and relevant regulations, the professional ensures that the decision is grounded in established legal and contractual principles, thereby upholding the insurer's duty of good faith and fair dealing. An incorrect approach would be to immediately deny the claim based on a superficial understanding of the policy or a desire to minimize payouts. This fails to meet the regulatory requirement for a thorough investigation and can lead to allegations of bad faith claims handling, a serious breach of PGI guidelines. Another incorrect approach would be to approve the claim without a detailed assessment, simply to avoid dispute. This disregards the insurer's responsibility to assess coverage accurately and can set a precedent for future claims, potentially leading to financial losses for the insurer and undermining the principle of risk-based pricing. A third incorrect approach would be to rely on anecdotal evidence or industry common practice not explicitly supported by the policy or PGI regulations. This introduces subjectivity and a lack of verifiable justification, which is contrary to the principles of regulatory compliance and fair claims settlement. Professionals should employ a decision-making framework that begins with understanding the policy's specific terms and conditions. This should be followed by a comprehensive investigation of the claim circumstances. Crucially, all decisions must be made in strict alignment with the PGI regulatory framework, including any specific directives on claims investigation, policy interpretation, and dispute resolution. When in doubt, seeking clarification from legal counsel or senior management, and documenting all steps and reasoning are essential components of professional conduct. Question 4. Investigation of a commercial property insurance application reveals discrepancies between the applicant's stated security measures and the insurer's standard underwriting requirements. The insurer is considering several approaches to gather further information. Which of the following represents the most compliant and professionally sound approach for the insurer to obtain the necessary details for underwriting? Option A. Relying on the applicant's verbal confirmation during a follow-up phone call that the security measures are adequate without further documentation. Option B. Conducting a broad, unannounced site visit to observe general activity and security without prior notification to the applicant. Option C. Requesting a detailed inspection of the property by a qualified independent assessor to verify the security measures and identify any potential risks not disclosed in the application. Option D. Making assumptions about the property's security based on its location and the general type of business, without direct verification. The correct answer is C. Requesting a detailed inspection of the property by a qualified independent assessor to verify the security measures and identify any potential risks not disclosed in the application. Explanation. This scenario is professionally challenging because it requires balancing the insurer's need for accurate risk assessment with the applicant's right to privacy and the regulatory obligation to obtain information in a fair and transparent manner. Misinterpreting or misapplying information gathering techniques can lead to adverse selection, underwriting errors, and potential regulatory breaches. The core challenge lies in ensuring that the information gathered is relevant, obtained ethically, and used appropriately for underwriting purposes, all within the confines of the program in general insurance, PGI, regulatory framework. The correct approach involves a systematic and compliant process of information gathering. This includes utilizing the application form as the primary source, supplemented by appropriate inspections and a thorough review of loss history. Each step must be conducted with transparency and in accordance with the PGI's guidelines on data collection and privacy. The regulatory justification for this approach is rooted in the principle of utmost good faith, which requires both the insurer and the insured to act honestly and disclose all material facts. Furthermore, regulations typically mandate that insurers have a reasonable basis for their underwriting decisions, which is achieved through diligent information gathering. Inspections, when conducted, must be for a legitimate underwriting purpose and not unduly intrusive. Loss history is a critical indicator of future risk, and its review is standard practice, provided it is obtained through legitimate channels. An incorrect approach would be to rely solely on an applicant's verbal assurances without corroboration from the application or other documented sources. This fails to meet the insurer's duty to underwrite responsibly and can lead to mispriced premiums or uninsurable risks. It also potentially breaches the principle of utmost good faith by not seeking to verify material information. Another incorrect approach would be to conduct an inspection that is overly intrusive or unrelated to the specific risks associated with the general insurance policy being applied for. This could violate privacy regulations and ethical guidelines concerning the scope of an insurer's inquiry. The inspection must be proportionate to the risk being assessed. A further incorrect approach would be to make assumptions about an applicant's risk profile based on stereotypes or generalizations, rather than on objective information gathered through the application, inspection, and loss history. This is not only ethically unsound, but also likely to lead to discriminatory underwriting practices, which are prohibited by regulatory frameworks. The professional decision-making process for similar situations should involve a clear understanding of the PGI's regulatory requirements for information gathering. This includes identifying the specific types of information that are permissible to collect, the methods of collection, and the purposes for which the information can be used. Professionals should always prioritize obtaining information through the application form, followed by appropriate and proportionate inspections and a review of verifiable loss history. Transparency with the applicant about the information being sought and the reasons for it is paramount. If there are any doubts about the legality or ethicality of a particular information gathering method, seeking guidance from compliance departments or regulatory bodies is essential. Question 5. The evaluation methodology shows that the underwriting department has identified a potential increase in claims frequency for a specific product due to evolving market conditions. However, the assessment primarily focuses on the historical claims data to project future losses, with minimal consideration given to the potential severity of individual claims or the broader reputational and regulatory implications if these claims become significant. Which approach to impact assessment best aligns with the principles of robust risk management in general insurance? Option A. An impact assessment that focuses solely on the likelihood of increased claims frequency without a detailed analysis of the potential severity or broader consequences. Option B. An impact assessment that prioritizes only the easily quantifiable financial losses from historical claims data, disregarding non-financial impacts. Option C. An impact assessment that relies exclusively on historical claims data to project future loss ratios, assuming current market conditions will persist. Option D. A comprehensive impact assessment that quantifies potential financial losses, considers reputational damage, and evaluates regulatory consequences, using both historical data and forward-looking scenario analysis. The correct answer is D. A comprehensive impact assessment that quantifies potential financial losses, considers reputational damage, and evaluates regulatory consequences, using both historical data and forward-looking scenario analysis. Explanation: this scenario is professionally challenging because it requires an insurer to move beyond a superficial understanding of risk management and demonstrate a robust application of its principles, particularly in the context of impact assessment. The challenge lies in accurately quantifying and prioritizing potential losses, which directly influences resource allocation for risk control and mitigation strategies. A failure to conduct a thorough impact assessment can lead to misallocation of resources, leaving the insurer vulnerable to significant financial and reputational damage, and potentially failing to meet its regulatory obligations to policyholders and the market. The correct approach involves a systematic and comprehensive evaluation of the potential consequences of identified risks. This includes considering financial losses, e.g., claims costs, increased operational expenses, reputational damage, regulatory penalties, and business interruption. By quantifying these impacts, the insurer can then prioritize risks based on their severity and likelihood, enabling the development of proportionate and effective control measures. This aligns with the overarching principles of prudent risk management expected under general insurance regulations, which mandate that insurers maintain adequate systems and controls to manage their risks effectively. The emphasis on understanding the magnitude of potential losses is crucial for informed decision-making and ensuring the insurer's solvency and stability. An incorrect approach that focuses solely on the likelihood of a risk occurring, without adequately considering its potential impact, is professionally unacceptable. This failure neglects the fundamental principle that a low-likelihood event can still be catastrophic if its impact is severe. Regulatory frameworks for general insurance emphasize a balanced consideration of both likelihood and impact to ensure comprehensive risk assessment. Another incorrect approach that prioritizes only easily quantifiable financial impacts, while ignoring less tangible but equally significant consequences such as reputational damage or regulatory scrutiny, is also professionally flawed. General insurance regulations often require a holistic view of risk, encompassing all potential negative outcomes that could affect the insurer's business and its ability to serve policyholders. Overlooking these broader impacts can lead to a false sense of security and inadequate risk mitigation. Finally, an approach that relies on historical data alone without considering emerging risks or changes in the operating environment is insufficient. While historical data is valuable, it may not reflect future trends or novel risks. Professional decision-making in risk management requires a forward-looking perspective, incorporating scenario planning and expert judgment to anticipate and assess potential future impacts, thereby ensuring the insurer remains resilient in a dynamic market. Professionals should adopt a structured decision-making process that begins with a clear understanding of the insurer's risk appetite and tolerance. This involves defining the scope of the risk assessment, identifying all relevant risks, and then systematically evaluating the potential impact of each risk across various dimensions: financial, operational, reputational, regulatory. The results of this impact assessment should then directly inform the selection and implementation of appropriate risk control and mitigation strategies, followed by ongoing monitoring and review. This iterative process ensures that risk management remains a dynamic and integral part of the insurer's operations. Question 6. The risk matrix shows a significant opportunity to increase market share by introducing a new type of insurance product. However, the product's structure and target market present novel scenarios that are not explicitly covered by current, well-established regulatory guidance. The intermediary's management is keen to capitalize on this opportunity quickly. Which approach best aligns with the regulatory framework's goals for the insurance industry? Option A. Proceed with the product launch immediately, assuming existing general principles of insurance law and consumer protection are sufficient, and address any potential issues if they arise. Option B. Prioritize the potential for increased commission and business volume, and proceed with the launch while informally seeking input from the insurer's compliance department. Option C. Rely solely on the insurer's legal and compliance teams to confirm the product's regulatory compliance, as they are ultimately responsible for the product's underwriting and claims handling. Option D. Halt the product launch and proactively engage with the relevant regulatory body to seek clarification and guidance on the product's compliance with the overarching goals of insurance regulation. The correct answer is A. Proceed with the product launch immediately, assuming existing general principles of insurance law and consumer protection are sufficient, and address any potential issues if they arise. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to balance commercial objectives with their fundamental regulatory obligations to protect consumers and ensure market integrity. The intermediary must navigate the potential for increased business against the imperative to comply with the overarching goals of insurance regulation. Careful judgment is required to identify and prioritize regulatory compliance over short-term profit. The correct approach involves proactively identifying and addressing potential regulatory gaps by seeking clarification from the relevant regulatory body. This demonstrates a commitment to understanding and adhering to the spirit and letter of the law, which is a primary goal of insurance regulation. Specifically, it aligns with the regulatory objective of ensuring fair treatment of customers and maintaining the solvency and stability of the insurance market. By seeking guidance, the intermediary is actively working to prevent potential breaches and uphold consumer confidence, thereby fulfilling its duty of care and regulatory responsibilities. An incorrect approach would be to proceed with the new product offering without seeking clarification, assuming existing guidelines are sufficient. This fails to acknowledge the potential for novel risks or interpretations of existing regulations, thereby contravening the regulatory goal of consumer protection and potentially exposing both the intermediary and the insurer to significant penalties and reputational damage. Another incorrect approach would be to prioritize the potential for increased commission and business volume over regulatory due diligence. This directly undermines the regulatory objective of market integrity and fair competition, as it suggests a willingness to engage in potentially non-compliant practices for financial gain. Finally, an incorrect approach would be to rely solely on the insurer's internal legal advice without independent verification or seeking direct regulatory input, especially when dealing with a new and potentially complex product. While insurer advice is valuable, the intermediary has its own direct regulatory responsibilities. Professionals should adopt a decision-making framework that begins with identifying potential regulatory implications of any new business initiative. This involves a thorough understanding of the relevant regulatory framework, including the stated goals of the regulator. When uncertainty exists, the framework dictates seeking clarification from the appropriate regulatory authority as a primary step, rather than proceeding with assumptions or relying solely on internal or external advice without independent verification. This proactive and transparent approach ensures that business decisions are made within the bounds of regulatory compliance, safeguarding both the firm and its clients. Question 7. The review process indicates a claim has been filed for significant damage to a large industrial printing press. The insured reports that the press suddenly stopped functioning, and upon inspection, it was discovered that a critical internal gear mechanism had fractured, causing extensive damage to surrounding components and rendering the press inoperable. The policy in question is a comprehensive general insurance policy. Which coverage part is most likely to respond to this loss? Option A, crime coverage. Option B, boiler and machinery coverage. Option C, property damage coverage. Option D, liability coverage. The correct answer is B, boiler and machinery coverage. Explanation. This scenario is professionally challenging because it requires the insurance professional to accurately identify the appropriate coverage part for a complex claim involving multiple potential perils. Misclassifying the claim can lead to significant financial implications for both the insurer and the insured, including underpayment of claims, denial of coverage, and potential regulatory scrutiny. Careful judgment is required to distinguish between property damage, liability exposure, and potential equipment breakdown. The correct approach involves a thorough analysis of the claim's root cause and the resulting damages, aligning them with the specific definitions and exclusions within the relevant coverage parts of a general insurance policy. This approach ensures that the claim is processed under the correct policy section, leading to fair and compliant claim settlement. Specifically, identifying that the damage originated from a mechanical failure of the machinery, rather than an external peril or a third-party action, points towards the boiler and machinery coverage. This coverage is designed to address losses arising from the sudden and accidental breakdown of specified machinery and equipment. Adhering to this classification is ethically sound, as it upholds the contractual agreement between the insurer and the insured, ensuring that the policy purchased provides the intended protection. It also aligns with regulatory expectations for accurate claims handling and policy interpretation. An incorrect approach would be to automatically assign the claim to property damage coverage simply because physical damage has occurred. This fails to recognize that property damage coverage typically applies to perils like fire, windstorm, or vandalism, and not to internal mechanical failures. This misclassification would likely result in a claim denial or underpayment, breaching the insurance contract and potentially violating consumer protection regulations that mandate fair claims handling. Another incorrect approach would be to consider liability coverage. This is inappropriate as there is no indication of a third party being injured or their property being damaged due to the insured's negligence. Liability coverage is designed to protect the insured against claims for damages they are legally obligated to pay to others. Applying this coverage would be a misapplication of policy terms and could lead to improper claim payouts, potentially exposing the insurer to financial losses it is not contractually obligated to cover. A further incorrect approach would be to classify the loss under crime coverage. Crime insurance typically covers losses resulting from theft, fraud, or other dishonest acts. The scenario describes a mechanical breakdown, not a criminal act. Misapplying crime coverage would be a fundamental misunderstanding of its purpose and would result in an incorrect claim disposition, failing to meet regulatory standards for accurate policy application. The professional decision-making process for similar situations should involve a systematic review of the claim facts, a detailed understanding of the policy's coverage parts, property, liability, crime, boiler, and machinery, and a clear identification of the peril causing the loss. When faced with ambiguity, consulting policy wordings, seeking clarification from underwriting, or referring to internal claims guidelines are crucial steps. The ultimate goal is to ensure the claim is handled in a manner that is both compliant with regulations and fair to the policyholder, reflecting the true intent of the insurance contract. Question 8. Strategic planning requires an insurer offering a range of general insurance products, from simple travel insurance to more complex commercial property policies, to determine the most effective and compliant distribution channels. Considering the regulatory framework for the program in general insurance, PGI, which of the following strategic decisions best aligns with ensuring both customer protection and regulatory adherence across its diverse product portfolio? Option A. Developing a hybrid model that utilizes a direct-to-consumer digital platform for standardized, low-complexity products, while leveraging a network of licensed agents and brokers for more complex or bespoke commercial policies requiring personalized advice. Option B. Implementing a predominantly direct-to-consumer digital platform for all product sales, supported by comprehensive online FAQs and self-service options. Option C. Expanding the use of call centers as the primary distribution channel, with agents trained to answer product queries and process applications for all policy types. Option D. Relying solely on partnerships with affinity groups and online aggregators to reach customers, with minimal direct insurer involvement in the sales process. The correct answer is B. Implementing a predominantly direct-to-consumer digital platform for all product sales, supported by comprehensive online FAQs and self-service options. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of how different insurance distribution channels interact with regulatory requirements and customer expectations within the program in general insurance, PGI framework. The core challenge lies in balancing the efficiency and reach of various distribution methods with the insurer's obligation to ensure fair treatment of customers and compliance with regulatory mandates regarding disclosure, advice, and suitability. Careful judgment is required to select the most appropriate channel for a specific product and target market, considering the inherent strengths and weaknesses of each. The correct approach involves a strategic alignment of the distribution channel with the complexity of the insurance product and the level of advice required by the customer. For simpler, standardized products with clear benefits and limited customization needs, a direct-to-consumer model or a digital platform can be highly effective and compliant, provided clear and accessible information is readily available. For more complex products requiring personalized assessment of needs and risk, or where regulatory requirements mandate a higher degree of advice, utilizing intermediaries like agents or brokers who are trained and authorized to provide such guidance is essential. This approach ensures that customers receive appropriate information and advice, leading to better informed purchasing decisions and adherence to regulatory principles of consumer protection. An incorrect approach would be to solely prioritize cost efficiency by defaulting to a direct-to-consumer model for all products, regardless of their complexity. This fails to meet regulatory obligations where personalized advice is necessary, potentially leading to mis-selling, customer dissatisfaction, and breaches of conduct rules. Another incorrect approach is to rely on agents or brokers without adequate training, oversight, or clear guidelines on their responsibilities, particularly concerning disclosure and suitability assessments. This can result in inconsistent advice, regulatory noncompliance, and reputational damage. Furthermore, adopting a one-size-fits-all distribution strategy that ignores the specific characteristics of different customer segments and their varying needs for information and advice is also professionally unsound and regulatorily risky. Professional reasoning in such situations should involve a systematic evaluation of the product's nature, the target customer's likely needs and sophistication, and the specific regulatory requirements for that product type. Insurers must consider the inherent risks associated with each distribution channel and implement appropriate controls and training to mitigate them. A robust governance framework that monitors channel performance, customer outcomes, and regulatory adherence is crucial for informed strategic planning and ongoing adaptation. Question 9. Assessment of how an insurance intermediary should respond when they identify a potential coverage gap in a client's existing general insurance policy that could lead to significant financial loss for the client, but disclosing this gap might jeopardize the renewal of the business. Option A. Remain silent about the coverage gap, assuming the client will review the policy wording themselves. Option B. Advise the client to seek independent legal advice regarding the policy wording. Option C. Vaguely mention that all policies have limitations without detailing the specific gap. Option D. Proactively inform the client about the potential coverage gap, explain its implications, and discuss potential solutions. The correct answer is D. Proactively inform the client about the potential coverage gap, explain its implications, and discuss potential solutions. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to balance their commercial interests with their fundamental duty of care to the client. The intermediary is aware of a potential coverage gap that could significantly impact the client's financial well-being, yet is incentivized to retain the business by not highlighting this issue. Navigating this conflict of interest requires a high degree of ethical judgment and a thorough understanding of regulatory obligations. The correct approach involves proactively informing the client about the potential coverage gap and explaining its implications. This demonstrates adherence to the duty of care, which mandates that intermediaries act in the best interests of their clients. Specifically, under the regulatory framework for general insurance in the UK, as governed by the Financial Conduct Authority (FCA), intermediaries have a responsibility to provide clear, fair, and not misleading information. This includes advising clients on the suitability of products and highlighting any limitations or potential shortfalls in coverage that are relevant to the client's needs. Failing to do so could be considered a breach of conduct rules, potentially leading to regulatory sanctions and reputational damage. An incorrect approach would be to remain silent about the coverage gap, hoping the client does not discover it or that the risk does not materialize. This is ethically unsound and a direct violation of the duty of care. It prioritizes the intermediary's commercial relationship over the client's protection, which is contrary to FCA principles, particularly Principle 6, Customers' Interest, and Principle 7, Communications with Clients. Another incorrect approach would be to vaguely mention that policies have limitations, without specifying the exact nature and potential impact of the gap. This is misleading because it does not provide the client with the necessary information to make an informed decision about their insurance needs and potential need for additional cover. This falls short of the FCA's requirement for clear and understandable communications. Finally, an incorrect approach would be to suggest the client review the policy wording themselves without offering any explanation or guidance. While clients are expected to read their policies, the intermediary's role is to assist them in understanding their insurance and to highlight material risks or gaps, especially when they are aware of them. This abdicates responsibility and fails to meet the standard of care expected. Professionals should adopt a decision-making framework that prioritizes client interests. This involves identifying potential conflicts of interest, assessing the impact of any identified issues on the client, and taking proactive steps to mitigate harm. Transparency and clear communication are paramount. When in doubt, it is always better to over-communicate and ensure the client is fully informed, rather than risk a breach of duty or regulatory noncompliance. Question 10. Upon reviewing the historical evolution of insurance practices, which development most significantly shaped the foundational principles and subsequent regulatory oversight of general insurance within the context of the program in general insurance, PGI, as defined by its specified jurisdiction? Option A. The establishment of Lloyd's of London in the 17th century, which formalized the role of individual underwriters and the concept of insurance syndicates. Option B. The emergence of early maritime insurance contracts in ancient Greece and Rome, focusing on the sharing of losses among ship owners. Option C. The widespread adoption of digital technologies and online platforms for insurance distribution in the late 20th and early 21st centuries. Option D. The development of complex actuarial science and statistical modeling in the 19th century, enabling more precise risk assessment and pricing. The correct answer is B. The emergence of early maritime insurance contracts in ancient Greece and Rome, focusing on the sharing of losses among ship owners. Explanation. This scenario is professionally challenging because it requires an understanding of how historical developments in insurance have shaped current regulatory frameworks and ethical considerations within the program in general insurance, PGI, context. Professionals must be able to discern which historical influences are most relevant to contemporary practice and regulatory compliance, avoiding anachronistic or irrelevant comparisons. Careful judgment is required to connect the evolution of insurance principles to the specific requirements of the PGI exam's jurisdiction. The correct approach involves identifying the historical development that most directly and significantly influenced the foundational principles of general insurance as understood and regulated within the PGI's specified jurisdiction. This approach is right because it demonstrates an understanding of the lineage of insurance practices and their subsequent codification into law and regulation. For instance, understanding the evolution from early mutual arrangements to more formalized contractual agreements, and how this shift necessitated regulatory oversight to protect policyholders, is crucial. This aligns with the PGI's objective of equipping individuals with a solid grasp of the industry's underpinnings, which are often reflected in current legislation and ethical guidelines designed to ensure fairness and solvency. An incorrect approach would be to focus on historical developments that are tangential to the core principles of general insurance, or that belong to entirely different financial sectors or geographical contexts not relevant to the PGI's jurisdiction. For example, discussing the history of life insurance in a jurisdiction other than the one specified for the PGI exam, or focusing on the development of complex financial derivatives that emerged much later and are not central to the foundational understanding of general insurance, would be professionally unacceptable. Such approaches fail to address the specific learning objectives of the PGI and demonstrate a lack of focus on the relevant regulatory and historical landscape. They also risk misinterpreting the evolution of insurance by drawing parallels from unrelated fields, leading to flawed conclusions about current practices and regulations. Professionals should approach such questions by first identifying the specific jurisdiction and regulatory framework governing the PGI. Then, they should consider the core concepts of general insurance, e.g., risk pooling, indemnity, utmost good faith, and trace their historical origins and evolution within that framework. The focus should be on developments that led to the establishment of modern insurance principles and the subsequent regulatory responses designed to ensure market stability and consumer protection. This analytical process ensures that the historical context provided is relevant, accurate, and directly applicable to the professional's understanding of their current role and responsibilities within the specified regulatory environment. Question 11. Governance review demonstrates that the general insurance company has identified an increasing trend in fraudulent claims. In response, the company is considering several strategies to enhance its fraud detection and prevention capabilities. Which of the following approaches best aligns with regulatory expectations and professional ethical standards for a general insurer operating under the program in general insurance, PGI framework. Option A. Deploy advanced data mining techniques across all customer data to identify potential fraud, without explicitly informing customers about the extent of data usage or obtaining specific consent for this purpose. Option B. Implement a policy of automatically rejecting any claim exhibiting unusual characteristics, without conducting a thorough investigation to verify the legitimacy of the claim. Option C. Develop and implement a multi-layered fraud management framework that includes proactive risk assessments, data analytics for anomaly detection, employee training on fraud indicators, and clear protocols for investigating suspicious claims, all while ensuring compliance with data privacy regulations and fair treatment of customers. Option D. Primarily focus on increasing the number of post-claim audits to identify fraudulent activity after claims have been paid, with the expectation that this will deter future fraudulent behavior. The correct answer is C. Develop and implement a multi-layered fraud management framework that includes proactive risk assessments, data analytics for anomaly detection, employee training on fraud indicators, and clear protocols for investigating suspicious claims, all while ensuring compliance with data privacy regulations and fair treatment of customers. Explanation: this scenario is professionally challenging because it requires balancing the imperative to detect and prevent fraud with the need to comply with regulatory requirements and maintain customer trust. Insurers operate under strict regulations designed to protect policyholders and ensure market integrity. A failure to adequately address fraud can lead to significant financial losses, reputational damage, and regulatory sanctions. Conversely, overly aggressive or poorly implemented fraud detection measures could alienate customers and lead to accusations of unfair treatment. The professional must navigate these competing demands by adhering to established regulatory frameworks and ethical principles. The correct approach involves implementing a comprehensive fraud management framework that is integrated into the insurer's operations and aligned with regulatory expectations. This framework should encompass proactive prevention strategies, robust detection mechanisms, and clear investigation and reporting procedures. Specifically, it requires a risk-based approach to fraud, focusing resources on areas with the highest potential for fraudulent activity. This aligns with the principles of good governance and the regulatory obligation to conduct business with due skill and care, ensuring that the insurer's financial health is not compromised by fraud. Furthermore, it demonstrates a commitment to fair treatment of customers by ensuring that legitimate claims are processed efficiently, while fraudulent ones are identified. An incorrect approach that relies solely on post-claim audits without proactive measures fails to meet regulatory expectations for a robust fraud prevention strategy. Regulators expect insurers to take a proactive stance in mitigating fraud risks, not just to react after a loss has occurred. This reactive approach can be costly and inefficient. Another incorrect approach that involves implementing intrusive data analytics without clear customer consent or a defined purpose risks violating data privacy regulations and eroding customer trust. While data analytics can be a powerful tool for fraud detection, its application must be governed by strict ethical guidelines and legal frameworks concerning data usage and privacy. A third incorrect approach that focuses solely on punitive measures against claimants without a fair and transparent investigation process is also professionally unacceptable. This disregards the principles of natural justice and could lead to accusations of bias and unfair dealing, potentially resulting in regulatory action and reputational damage. Professionals should employ a decision-making process that prioritizes regulatory compliance, ethical conduct, and a risk-based approach. This involves understanding the specific regulatory requirements for fraud management within their jurisdiction, assessing the insurer's fraud risk profile, and developing and implementing a proportionate and effective fraud management strategy. Regular review and adaptation of this strategy, based on emerging fraud trends and regulatory updates, are crucial. Question 12. Performance analysis shows that a significant corporate client's renewal is imminent, and the primary contact person for the insurance program has consistently demonstrated a lack of understanding regarding the policy's intricacies and has appeared to delegate critical decisions to junior staff. The insurance intermediary is concerned that this individual may not possess the necessary authority or comprehension to act as a competent party in negotiating and agreeing to the terms of the renewal. What is the most appropriate course of action for the insurance intermediary? Option A. Proceed with the renewal based on the existing policy terms, assuming the client will raise any objections if they arise. Option B. Discreetly seek confirmation from the client regarding the individual's authority and understanding of the insurance program's needs and the renewal terms, explaining the importance of ensuring the policy accurately reflects their requirements and is legally sound. Option C. Immediately inform the insurer of the concerns regarding the client's contact person's competency without further investigation or discussion with the client. Option D. Advise the client that their current contact person is not competent to handle the renewal and suggest they appoint someone else. The correct answer is B. Discreetly seek confirmation from the client regarding the individual's authority and understanding of the insurance program's needs and the renewal terms, explaining the importance of ensuring the policy accurately reflects their requirements and is legally sound. Explanation. This scenario presents a professional challenge because it requires an insurance intermediary to balance the need to secure business with the fundamental ethical and regulatory obligation to ensure that all parties to an insurance contract are competent. The intermediary is aware of a potential issue with the competency of a key individual representing a large corporate client, which could invalidate the insurance policy. The challenge lies in navigating this information without jeopardizing the business relationship or breaching confidentiality, while still upholding professional standards and regulatory requirements. The correct approach involves discreetly seeking clarification from the client regarding the individual's authority and understanding of the insurance needs, without making direct accusations or assumptions. This upholds the principle of acting with integrity and in the best interests of both the client and the insurer. Specifically, the intermediary should communicate their need for confirmation of authority and understanding to ensure the policy accurately reflects the client's requirements and is legally sound. This aligns with the regulatory framework's emphasis on ensuring that contracts are entered into by competent parties, thereby preventing potential disputes and financial losses for all involved. The intermediary's duty of care extends to ensuring the client understands the implications of the insurance and that the policy is appropriate. An incorrect approach would be to proceed with the policy without addressing the competency concern. This fails to meet the regulatory requirement for competent parties and exposes both the client and the insurer to significant risk. It also breaches the intermediary's duty to act with due diligence and professional care. Another incorrect approach would be to immediately report the concern to the insurer without first attempting to resolve it with the client. This could be seen as a breach of client confidentiality and could unnecessarily damage the business relationship. While transparency with the insurer is important, it should follow a reasonable attempt to gather facts and address the issue directly with the client, where appropriate. A further incorrect approach would be to ignore the information and assume the individual is competent. This demonstrates a lack of professional diligence and a disregard for the regulatory framework's emphasis on ensuring valid contractual agreements. It prioritizes securing the business over fulfilling professional and regulatory obligations. The professional decision-making process in such situations should involve 1. Identifying the potential ethical and regulatory issue competency of a party. 2. Assessing the impact of the issue on the client, insurer, and intermediary. 3. Considering the relevant regulatory requirements and professional codes of conduct. 4. Developing a plan of action that prioritizes integrity, client best interests, and regulatory compliance, which may involve seeking clarification, providing information, or escalating the matter if necessary. Question 13. Implementation of a business interruption insurance review for a long-standing client whose business operations have recently undergone significant technological upgrades requires the insurance broker to consider several approaches. Which approach best upholds the broker's professional and regulatory obligations? Option A. Inform the client that business interruption insurance is complex and that they should seek advice directly from the insurer, as the broker's role is primarily administrative. Option B. Conduct a comprehensive review of the client's current operations and the existing business interruption policy wording, identifying potential coverage gaps or inadequacies arising from the technological upgrades, and then recommend specific policy enhancements or alternative coverage options to ensure adequate protection. Option C. Proceed with the renewal of the existing business interruption policy, as it has served the client adequately in the past, and the client has not requested any changes. Option D. Advise the client to purchase a generic, low-cost business interruption policy that offers broad, unspecified coverage to minimize premium expenditure. The correct answer is C. Proceed with the renewal of the existing business interruption policy, as it has served the client adequately in the past, and the client has not requested any changes. Explanation: this scenario is professionally challenging because it requires an insurance broker to balance the client's immediate perceived needs with the long-term implications of policy wording and regulatory compliance. The broker must act in the client's best interest while adhering to the principles of good faith and ensuring the policy accurately reflects the risks being insured. The complexity arises from the potential for ambiguity in business interruption clauses and the need to ensure the client understands the coverage limitations. The correct approach involves a thorough review of the existing business interruption policy, identifying any potential gaps or ambiguities in relation to the client's specific operational risks, and then recommending policy enhancements or alternative coverage that aligns with regulatory expectations for adequate protection. This approach is correct because it prioritizes the client's actual insurance needs over a superficial understanding of coverage. It aligns with the regulatory framework's emphasis on ensuring that insurance products provide genuine protection and that clients are not underinsured due to inadequate policy terms. The broker's duty of care and professional conduct mandates proactive advice and a commitment to ensuring the policy meets the client's business continuity requirements, as stipulated by general insurance regulations. An incorrect approach would be to simply renew the existing policy without a detailed review, assuming it adequately covers the client's needs. This fails to meet the broker's duty to advise and could leave the client exposed to significant financial loss, violating the principle of providing suitable advice. Another incorrect approach would be to recommend a policy that offers broad, vague coverage without clearly explaining its limitations or the specific triggers for a claim. This misrepresents the coverage and could lead to disputes and regulatory scrutiny for misleading the client. A further incorrect approach would be to focus solely on the lowest premium without adequately assessing the scope and adequacy of the business interruption coverage, thereby failing to act in the client's best interest and potentially breaching regulatory requirements for suitability. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's business operations and their specific vulnerabilities to disruption. This should be followed by a detailed analysis of the existing insurance policy, specifically focusing on the business interruption section. The next step involves identifying any discrepancies between the client's risk profile and the policy's coverage, considering potential triggers, indemnity periods, and exclusions. Finally, the professional should present clear, actionable recommendations to the client, explaining the rationale behind any proposed changes and ensuring the client fully understands the implications of their chosen coverage. This structured approach ensures that advice is informed, client-centric, and compliant with regulatory standards. Question 14. Which approach would be most appropriate for a claims assessor to determine the settlement amount for a damaged piece of office furniture under a general insurance policy, considering the principle of indemnity and the regulatory framework of the program in general insurance, PGI? Option A. Valuing the furniture based on the cost of a higher specification, more modern equivalent item. Option B. Offering a settlement based on the original purchase price of the furniture, irrespective of its age or condition. Option C. Calculating the replacement cost (RC) of the furniture, assuming the policy allows for the purchase of a brand new equivalent item. Option D. Determining the actual cash value (ACV) of the furniture, reflecting its depreciated market value immediately prior to the loss. The correct answer is D. Determining the actual cash value (ACV) of the furniture, reflecting its depreciated market value immediately prior to the loss. Explanation: this scenario is professionally challenging because it requires the claims assessor to apply the correct valuation method for a damaged asset, ensuring fairness to both the policyholder and the insurer, while strictly adhering to the program in general insurance, PGI, regulatory framework. The core of the challenge lies in interpreting the policy wording and the applicable regulations to determine the appropriate basis for settlement, avoiding both underpayment and overpayment. The correct approach involves determining the actual cash value, ACV, of the damaged item. This method reflects the current market value of the item immediately before the loss, taking into account depreciation due to age, wear and tear, and obsolescence. This aligns with the PGI's emphasis on indemnity, which aims to restore the policyholder to the financial position they were in before the loss occurred, no more and no less. Adhering to ACV ensures that the insurer is not paying for a new item when the insured owned an older, depreciated one, thereby fulfilling the principle of indemnity and complying with regulatory expectations for fair claims settlement. An incorrect approach would be to automatically apply replacement cost, RC, without considering the policy terms and the principle of indemnity. If the policy specifies ACV as the basis for settlement, using RC would result in an overpayment, potentially violating regulatory guidelines that prevent insurers from profiting from a loss. Another incorrect approach would be to offer a settlement based on the item's original purchase price without accounting for depreciation. This also fails to adhere to the principle of indemnity and the ACV calculation, leading to an inaccurate and potentially unfair settlement. A further incorrect approach would be to offer a settlement based on the cost of a similar but superior item. This would also constitute an overpayment and a deviation from the principle of indemnity. Professionals should approach such situations by first meticulously reviewing the insurance policy wording to identify the agreed-upon valuation method. They must then consult the relevant PGI regulatory guidelines and any applicable case law to understand the legal interpretation of these valuation methods. The claims assessor should then gather all necessary information to accurately calculate the value based on the determined method, ensuring transparency and clear communication with the policyholder throughout the process. Question 15. The analysis reveals that a consulting firm specializing in financial planning and investment advice is seeking insurance coverage. Their primary concern is protecting the firm from claims where clients allege they suffered significant financial losses due to incorrect or inadequate financial advice provided by the firm's consultants. The firm's operations are conducted from a leased office space, and they have a board of directors overseeing strategic decisions. Based on these facts, which type of liability policy is most critical for addressing the firm's core risk? Option A, professional liability insurance. Option B, a combination of commercial general liability and directors and officers liability insurance. Option C, directors and officers liability insurance. Option D, commercial general liability insurance. The correct answer is A, professional liability insurance. Explanation: this scenario presents a professional challenge because it requires the insurance broker to accurately identify the most appropriate liability policy to cover a client's specific risks, given the nuances between commercial general liability, CGL, professional liability, and directors and officers, D&O liability. Misclassification can lead to significant coverage gaps, leaving the client exposed to substantial financial losses and potentially exposing the broker to professional negligence claims. Careful judgment is required to understand the distinct triggers and scope of each policy type. The correct approach involves recommending professional liability insurance because the core of the client's business involves providing advice and services where errors or omissions in that advice could lead to financial harm for their clients. Professional liability policies are designed to cover claims arising from negligence, errors, or omissions in the performance of professional services. This aligns directly with the described risk of a client suffering financial loss due to the firm's advice. This approach is ethically sound and compliant with regulatory expectations for brokers to act in the best interests of their clients by ensuring adequate and appropriate coverage. An incorrect approach would be to recommend only commercial general liability insurance. This policy typically covers bodily injury and property damage arising from the business's operations, premises, or products, but generally excludes coverage for financial loss resulting from professional advice or services. Relying solely on CGL would fail to address the primary risk identified. Another incorrect approach would be to recommend only directors and officers liability insurance. This policy protects the personal assets of company directors and officers, and the company itself, from claims alleging wrongful acts in their management and oversight of the company. While a firm might have directors and officers, the scenario focuses on the risk to the firm from its client-facing advisory services, not on management decisions. A further incorrect approach would be to recommend a combination of CGL and D&O without also including professional liability. This would still leave a critical gap in coverage for the core professional services risk. The professional decision-making process for similar situations should involve a thorough understanding of the client's business operation, the specific risks they face, and the precise coverage provided by different types of insurance policies. Brokers must actively listen to client needs, ask probing questions to uncover all potential exposures, and then match those exposures to the most suitable insurance products, always prioritizing the client's best interests and adhering to regulatory requirements for advice and disclosure. Question 16. Risk assessment procedures indicate that a technology consulting firm, which handles sensitive client data and relies heavily on cloud-based infrastructure, is seeking comprehensive insurance coverage for potential data breaches and cyber attacks. Which of the following approaches best aligns with responsible underwriting practices and regulatory expectations for general insurance in this jurisdiction? Option A. Underwrite the policy based solely on historical claims data for general liability insurance, without specific consideration for the unique and evolving nature of cyber risks. Option B. Offer a broad policy that covers all cyber-related losses without specific exclusions or conditions, assuming that the technology consulting firm by its nature is highly secure. Option C. Develop a policy that clearly defines covered perils, including specific types of data breaches and cyber attack events, outlines policyholder responsibilities for maintaining reasonable cybersecurity measures, and includes sublimits for specific types of losses, based on a detailed assessment of the firm's specific vulnerabilities and the current threat landscape. Option D. Provide a standard cyber insurance policy designed for small businesses, as the technology consulting firm is a medium-sized enterprise, without conducting a specific risk assessment of its operations. The correct answer is C. Develop a policy that clearly defines covered perils, including specific types of data breaches and cyber attack events, outlines policyholder responsibilities for maintaining reasonable cybersecurity measures, and includes sublimits for specific types of losses, based on a detailed assessment of the firm's specific vulnerabilities and the current threat landscape. Explanation. This scenario is professionally challenging because it requires an insurer to balance the need to provide comprehensive coverage for emerging risks like data breaches and cyber attacks with the practicalities of underwriting and pricing such complex and evolving threats. The insurer must consider its own capacity, the availability of reinsurance, and the potential for systemic risk. Careful judgment is required to ensure that coverage is both adequate for the policyholder and sustainable for the insurer, while adhering to regulatory requirements for fair treatment of customers and solvency. The correct approach involves a thorough and ongoing assessment of cyber risks, including the specific vulnerabilities and threat landscape relevant to the insured's industry and operations. This includes understanding the types of data handled, the security measures in place, and the potential impact of a breach. The insurer should then tailor policy wordings to clearly define what is covered, what is excluded, and the conditions for coverage, such as the requirement for the insured to maintain reasonable security practices. This approach is ethically and regulatorily sound as it promotes transparency, ensures that policyholders understand their coverage, and aligns with the regulatory expectation that insurers underwrite risks responsibly and maintain adequate capital to meet their obligations. It also reflects the principle of utmost good faith by ensuring that the policy accurately reflects the risk being insured. An incorrect approach that focuses solely on historical claims data without considering the dynamic nature of cyber threats would be professionally unacceptable. This fails to account for the rapid evolution of cyber attack methods and the increasing sophistication of threat actors, potentially leading to underpricing and inadequate reserves. It also risks leaving policyholders underinsured for emerging threats, violating the principle of fair treatment. Another incorrect approach that offers broad, undefined coverage for all cyber-related losses, without clear exclusions or conditions, would also be problematic. This lacks the necessary specificity for underwriting and claims handling, potentially exposing the insurer to unforeseen liabilities and impacting its financial stability. It also fails to meet regulatory expectations for clear and understandable policy terms, potentially leading to disputes and customer dissatisfaction. A third incorrect approach that relies heavily on generic cyber insurance products without tailoring them to the specific risks of the insured business would be professionally deficient. Cyber risks are highly varied by industry and business model. A one-size-fits-all approach may not adequately address the unique exposures of a particular policyholder, leading to either insufficient coverage or overinsurance, neither of which is optimal. The professional decision-making process for similar situations should involve a structured risk assessment framework that includes understanding the client's business and its specific cyber exposures, evaluating the effectiveness of the client's existing cybersecurity controls, identifying relevant regulatory and legal obligations, assessing the insurer's own risk appetite and capacity, and developing clear, unambiguous policy terms and conditions that accurately reflect the agreed-upon coverage and responsibilities. Regular review and updating of cyber insurance products and underwriting guidelines are also crucial given the evolving threat landscape. Question 17. Risk assessment procedures indicate that a potential commercial property insurance applicant operates in a highly regulated industry and has recently been involved in a significant contractual dispute that is currently in arbitration. Which of the following approaches best addresses the potential legal hazards associated with this applicant? Option A. Conduct a detailed review of the applicant's regulatory compliance history, terms of the ongoing arbitration, and any relevant contractual indemnities to assess potential legal liabilities. Option B. Focus primarily on the applicant's historical claims data and current financial stability, as these are the most direct indicators of insurability. Option C. Prioritize the applicant's operational efficiency and market share, as these factors are more indicative of long-term business success and reduced risk. Option D. Assume that the regulatory body will not take punitive action unless a formal investigation is underway, and that the arbitration will be resolved favorably for the applicant. Correct answer is B. Focus primarily on the applicant's historical claims data and current financial stability, as these are the most direct indicators of insurability. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for accurate risk assessment with the potential for legal repercussions arising from misrepresentation or non-disclosure. The underwriter must navigate the complexities of identifying and quantifying legal hazards, which are often intangible and can manifest in various ways, impacting the insurer's liability. Careful judgment is required to ensure that all relevant legal risks are considered without unduly delaying the underwriting process or creating unnecessary barriers to insurance coverage. The correct approach involves a thorough review of the insured's business operation, contractual obligations, and any existing litigation or regulatory investigations. This proactive identification of potential legal exposures allows for appropriate pricing and terms to be applied, or for the risk to be declined if it is uninsurable. This aligns with the regulatory framework's emphasis on prudent underwriting and the duty of utmost good faith, ensuring that the insurer is aware of and has accounted for all material risks. Specifically, it reflects the principles of identifying and assessing all relevant factors that could influence the likelihood or severity of a claim, including those stemming from legal liabilities. An incorrect approach that focuses solely on the insured's financial statements without considering their legal exposures would fail to identify significant legal hazards. This oversight could lead to underpricing the risk, potentially resulting in substantial losses for the insurer if a legal claim arises. This contravenes the regulatory expectation that insurers conduct comprehensive risk assessments. Another incorrect approach that involves ignoring potential regulatory noncompliance because it has not yet resulted in a formal penalty would be a significant ethical and regulatory failure. Regulatory noncompliance, even if not yet penalized, represents a clear legal hazard that could lead to fines, sanctions, or reputational damage, all of which impact the insurer's exposure. Failing to account for this would breach the duty of care and potentially expose the insurer to unforeseen liabilities. A further incorrect approach that dismisses the impact of contractual indemnities on the insured's liability, assuming they will always be upheld, is also flawed. While contracts are legally binding, their enforceability can be challenged, and the interpretation of indemnity clauses can be complex and lead to disputes. Ignoring these potential complexities in the assessment of legal hazards would be an inadequate risk assessment. Professionals should adopt a decision-making framework that prioritizes a holistic understanding of the insured's risk profile. This involves actively seeking information about potential legal exposures, consulting with legal experts when necessary, and ensuring that underwriting decisions are informed by a comprehensive assessment of all material risks, including legal hazards. The process should be iterative, allowing for adjustments as new information becomes available. Question 18. System analysis indicates that an underwriter is reviewing a proposal for a new type of business insurance. The proposed policy aims to provide financial compensation to a business if it experiences a significant decline in revenue due to a general economic recession. The business owner argues that this is a substantial financial risk that they wish to mitigate through insurance. Based on the regulatory framework for general insurance in the UK, which of the following characteristics of insurable risks is most critically challenged by this proposal? Option A, the risk is definite and measurable. Option B, the risk is fortuitous and accidental. Option C, the risk is subject to the law of large numbers. Option D, the risk is non-catastrophic and calculable. The correct answer is B. The risk is fortuitous and accidental. Explanation. This scenario is professionally challenging because it requires an underwriter to apply the fundamental characteristics of insurable risk to a real-world proposal, ensuring that the proposed insurance contract aligns with regulatory principles designed to maintain the solvency and fairness of the insurance market. Misjudging these characteristics can lead to adverse selection, moral hazard, and ultimately, financial instability for the insurer, potentially impacting policyholders and the broader market. Careful judgment is required to distinguish between risks that are inherently insurable and those that are not, based on established criteria. The correct approach involves identifying that the risk of a business experiencing a general economic downturn, while a business risk lacks the specific characteristics of insurability required by regulatory frameworks. Specifically, it is not a fortuitous, definite, or measurable event in the way required for insurance. Economic downturns are often systemic, predictable to some extent, and their impact can be difficult to quantify precisely for insurance purposes. Regulatory guidance, such as that found in the FCA's Principles for Businesses and the PRA's Rulebook, emphasizes that insurers must manage risks prudently and ensure that products offered are fair and do not expose policyholders to undue risk. Insuring against broad economic trends would likely violate principles of risk pooling and the law of large numbers, as the event affects a significant portion of the insured population simultaneously, making it uninsurable. An incorrect approach would be to accept the risk based solely on the potential for profit or the client's insistence, without a thorough assessment of its insurability. This fails to uphold the duty of care owed to policyholders and the insurer's own financial stability, potentially contravening regulatory requirements for prudent risk management. Another incorrect approach is to attempt to insure against the general economic downturn by creating a policy that is overly broad or vague in its triggers and payouts. This would likely lead to disputes, claims that are difficult to assess, and could be seen as mis-selling or offering a product that does not meet the fundamental requirements of an insurance contract, thus failing to comply with consumer protection regulations. A further incorrect approach is to focus only on the financial capacity of the client to pay premiums, ignoring the underlying insurability of the risk itself. This prioritizes commercial gain over regulatory compliance and sound underwriting principles. Professionals should employ a decision-making framework that begins with a clear understanding of the core principles of insurability: fortuitousness, definiteness, measurability, calculability, non-catastrophic nature, and common risk. Each proposed risk should be evaluated against these criteria. If a risk fails to meet one or more of these fundamental characteristics, the professional must then consider whether the risk can be modified or excluded to become insurable, or if it must be declined. This process must be documented, with clear reasoning based on the established principles and relevant regulatory guidance, ensuring transparency and accountability. Question 19. Market research demonstrates that a significant portion of the general insurance market is experiencing an increase in claims related to a specific type of property damage. An underwriter is tasked with updating the hazard identification process for this line of business to ensure accurate risk assessment and pricing. Which of the following approaches would be most professionally sound and compliant with regulatory expectations for hazard identification? Option A. Relying on anecdotal evidence from sales representatives about which types of policyholders are more prone to this damage, and adjusting risk assessments based on these general observations. Option B. developing a new hazard identification model based on assumptions about the lifestyle and habits of policyholders in specific geographic regions, without direct correlation to the actual property damage. Option C. Implementing a hazard identification process that categorizes policyholders based on their age and occupation, assuming these factors are direct indicators of their propensity to experience this type of property damage. Option D. Analyzing historical claims data for the specific property damage, correlating it with environmental factors and building materials, and consulting industry loss trend reports to identify the root causes and frequency of such events. The correct answer is D. Analyzing historical claims data for the specific property damage, correlating it with environmental factors and building materials, and consulting industry loss trend reports to identify the root causes and frequency of such events. Explanation. This scenario presents a professional challenge because it requires an insurance underwriter to balance the need for accurate risk assessment with the practical limitations of data availability and the potential for bias. The core of the challenge lies in identifying and quantifying hazards effectively, which is fundamental to the program in General Insurance, PGI, Principles of Prudent Underwriting and Fair Pricing. The underwriter must navigate the ethical imperative to avoid discriminatory practices while ensuring the insurer's solvency and the equitable treatment of policyholders. Careful judgment is required to select an approach that is both compliant with regulatory expectations and robust in its risk assessment methodology. The correct approach involves a systematic and data-driven method for hazard identification that prioritizes objective evidence and avoids reliance on subjective or potentially discriminatory factors. This aligns with the principles of good governance and fair dealing expected of insurance professionals. Specifically, it involves leveraging a combination of historical claims data, industry-wide loss trends, and expert actuarial analysis to identify common hazards and their associated risk profiles. This method is ethically sound as it focuses on the inherent risks of the insured activity or property, rather than characteristics of the policyholder that are irrelevant to the risk itself. It is also regulatorily compliant, as it promotes transparency and fairness in underwriting, preventing arbitrary denial of coverage or unfair pricing. An incorrect approach that relies on broad generalizations or stereotypes about specific demographic groups for hazard identification is professionally unacceptable. This fails to meet the regulatory requirement for objective risk assessment and can lead to unfair discrimination, which is prohibited. Such an approach is ethically flawed because it penalizes individuals based on group affiliation rather than their individual risk profile. Another incorrect approach that neglects to update hazard identification models with emerging trends or new data sources is also problematic. This can lead to inaccurate risk pricing, potentially undercharging for significant risks or overcharging for less severe ones, impacting both the insurer's financial stability and the fairness to policyholders. This also fails to meet the professional obligation to maintain up-to-date knowledge and apply best practices in risk assessment. A third incorrect approach that solely relies on anecdotal evidence or individual underwriter intuition without supporting data or established methodologies lacks the rigor required for sound underwriting. This is not only professionally weak, but also fails to provide a defensible basis for underwriting decisions, potentially exposing the insurer to unforeseen losses and regulatory scrutiny. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the scope of the risk being assessed. Second, identify all potential data sources, prioritizing objective and verifiable information. Third, employ established methodologies for hazard identification and risk quantification, such as statistical modeling and actuarial analysis. Fourth, critically evaluate the identified hazards for any potential for bias or unfair discrimination, ensuring compliance with all relevant regulations. Finally, document the entire process and the rationale for the underwriting decision, allowing for review and accountability. Question 20. Consider a scenario where a policyholder, after a fire at their home, claims reimbursement for the purchase of new clothing and essential toiletries to replace items destroyed in the incident. The homeowner's policy defines personal effects broadly, but includes a clause stating that coverage for replacement items is limited to necessary replacements that are reasonably equivalent to the lost items. The policyholder has purchased higher-end brands for their replacements than they owned previously, What is the most appropriate approach for the insurer to take in assessing this claim? Option A. Deny reimbursement for the replacement items, arguing that the purchase of higher-end brands exceeds the reasonably equivalent standard and is not a necessary replacement in the context of the policy. Option B. Approve the full reimbursement for all purchased replacement items, as they are essential for the policyholder's daily life, and the policy covers personal effects. Option C. Engage with the policyholder to understand the specific items purchased, compare them to the likely value and nature of the lost items, and determine if the replacements meet the necessary replacement and reasonably equivalent criteria as defined by the policy, offering a settlement based on this assessment. Option D. Offer a fixed, predetermined amount for clothing and toiletries replacement, regardless of the actual items purchased, to expedite the claims process. The correct answer is B. Approve the full reimbursement for all purchased replacement items, as they are essential for the policyholder's daily life, and the policy covers personal effects. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance professional to interpret policy wording and apply it to a specific claim situation involving personal property. The ambiguity in the policy's definition of personal effects and the insured's interpretation of what constitutes a necessary replacement can lead to disputes. The professional must balance the insurer's obligation to indemnify with the insured's reasonable expectations, all while adhering to regulatory requirements and ethical conduct. Correct approach analysis. The correct approach involves a thorough review of the policy wording, specifically the definition of personal effects, and any exclusions or limitations related to replacement. It also requires understanding the regulatory framework governing claims handling, which mandates fair and prompt settlement. The professional should engage in a dialogue with the insured to understand the nature of the items lost and the circumstances of their replacement, seeking to reach a mutually agreeable resolution that aligns with the policy terms and regulatory expectations. This approach prioritizes clear communication, adherence to contractual obligations, and fair treatment of the policyholder. Incorrect approach is analysis. One incorrect approach is to immediately deny coverage for the replacement items based solely on the insured's initial claim without further investigation or clarification of the policy terms. This fails to uphold the duty of good faith and fair dealing, potentially violating regulatory requirements for claims handling. Another incorrect approach is to approve the full cost of the replacement items without verifying if they fall within the policy's definition of personal effects, or if they represent a necessary replacement, as per the policy. This could lead to overpayment and a breach of the insurer's contractual obligations, potentially exposing the insurer to financial risk and regulatory scrutiny for improper claims settlement. A third incorrect approach is to offer a settlement that is significantly less than the actual replacement cost of the items without a clear, policy-based justification. This could be perceived as an attempt to underpay the claim, leading to a breach of contract and potential regulatory sanctions for unfair claims practices. Professional reasoning. Professionals should approach such situations by first meticulously examining the policy contract, paying close attention to definitions, exclusions, and conditions. They must then gather all relevant facts from the insured and any other sources. Communication with the insured should be transparent and empathetic, explaining the policy provisions clearly. If there is ambiguity, the professional should interpret it in favor of the insured, provided it is reasonable and consistent with the policy's intent. The decision-making process should be guided by the principles of fairness, good faith, and adherence to the regulatory framework governing insurance claims.